The stock market is like a roller coaster. It's a thrilling ride that can be both exhilarating and terrifying, often at the same time. Just like a roller coaster, the stock market has its peaks and valleys, its moments of rapid ascent and sudden drops. It has its ups and downs. These fluctuations are a natural part of the market's behavior, driven by a myriad of factors including economic data, corporate earnings, geopolitical events, and investor sentiment. Sometimes it goes up for a long time. This period of sustained growth is known as a bull market. During a bull market, investor confidence is high and stock prices generally increase, leading to a sense of optimism and prosperity. This is called a bull market. Sometimes it goes down. Conversely, when the market experiences prolonged declines, it enters what is known as a bear market. In a bear market, investor confidence wanes and stock prices fall, often leading to a more cautious and sometimes fearful approach to investing. This is called a bear market. Bear markets can be challenging, but they are also a natural part of the economic cycle. They can provide opportunities for savvy investors to buy stocks at lower prices, positioning themselves for future gains when the market eventually recovers. Market corrections are a normal part of this cycle. A market correction is typically defined as a decline of 10% or more in the price of a security, asset, or market index. Corrections can occur in any asset class and are often seen as a healthy adjustment that can prevent bubbles from forming. They can happen quickly and be scary. The suddenness of a market correction can catch investors off guard, leading to panic selling and increased volatility. However, it's important to remember that corrections are temporary and often short-lived. But they don't always mean something is wrong with the economy. Corrections can be triggered by a variety of factors, including changes in interest rates, economic data releases, or geopolitical events. They are not necessarily indicative of a broader economic downturn. Understanding market corrections is important for every investor. By recognizing that corrections are a normal part of the market cycle, investors can avoid making impulsive decisions based on fear or uncertainty. It helps you make smart decisions with your money. Staying informed and maintaining a long-term perspective can help investors navigate through market corrections and take advantage of opportunities that arise during these periods. When you know what to expect, you can ride out the lows and enjoy the highs. By understanding the nature of market fluctuations, investors can remain calm and focused, making strategic decisions that align with their financial goals and risk tolerance. A market correction is a sudden drop in the stock market. This term is used to describe a decline of at least 10% in the price of a security, asset, or a financial market. It is a common occurrence in the financial world and can happen to individual stocks, sectors, or the market as a whole. It happens when stock prices fall by 10% or more from their most recent peak. This decline can be triggered by various factors, including economic data, geopolitical events, or changes in investor sentiment. These drops can happen within days or weeks, and they often catch investors off guard. The speed and severity of a correction can vary, but the impact is usually felt across the market. This can be unsettling for investors, especially those who are new to the market or have a low tolerance for risk. Seeing the value of investments drop suddenly can lead to panic selling, which can exacerbate the decline. Corrections are different from bear markets. While a correction is a short-term drop of 10% or more, a bear market is a prolonged period of decline, typically defined as a drop of 20% or more from recent highs. Bear markets are longer periods of decline that can last for months or even years. They are often associated with economic recessions and can have a significant impact on investor confidence and market stability. They can last for months or even years, causing prolonged periods of uncertainty and financial strain for investors. Understanding the difference between a correction and a bear market is crucial for making informed investment decisions. Corrections are shorter and sharper, often followed by a quick recovery. They can serve as a reality check for the market, helping to prevent bubbles and maintain long-term stability. It's important to remember that market corrections are a natural part of the economic cycle. They can help to correct overvaluations and bring prices back to more sustainable levels. They can present buying opportunities for savvy investors who are able to identify undervalued assets and take advantage of lower prices. By staying informed and maintaining a long-term perspective, investors can navigate market corrections with confidence and potentially benefit from the opportunities they present. Several things can trigger a market correction. Bad news about the economy can cause investors to worry. This worry can lead to selling. Global events can also play a role. Think about a pandemic or a war. These events can shake investor confidence and lead to market downturns. Sometimes corrections happen for no clear reason. The market can be unpredictable. That's why it's important to be prepared. The Federal Reserve, or the Fed, is like a referee for the U.S. economy. It controls interest rates. Interest rates are like the price of money. When the Fed cuts interest rates, it becomes cheaper to borrow money. This can encourage people to spend and invest more. This can help the economy grow. The Fed lowers interest rates to stimulate the economy during a downturn. This is where rate cuts come in. Section 5. Why rate cuts happen. Giving the economy a boost. In this section, we will explore the mechanisms and impacts of rate cuts on the economy and how they serve as a tool for economic stabilization. The Federal Reserve, often referred to as the Fed, uses rate cuts to try to prevent or soften a recession. By lowering interest rates, the Fed aims to make borrowing cheaper, which can stimulate economic activity. A recession is a period of economic decline, characterized by a decrease in industrial activity, rising unemployment, and falling consumer spending. During such times, businesses may close and investments may dwindle. Rate cuts are like giving the economy a shot of espresso. Just as a strong cup of coffee can energize a person, a rate cut can invigorate economic activities by making money more accessible. They make borrowing cheaper for businesses and consumers. When interest rates are low, businesses are more likely to take out loans to expand operations, invest in new projects, or hire more employees. Consumers, on the other hand, may find it easier to finance big-ticket purchases like homes and cars. This can lead to more spending and investment. Increased consumer spending can drive demand for goods and services, prompting businesses to ramp up production and potentially hire more workers. Similarly, lower borrowing costs can encourage investment in infrastructure and other long-term projects. Rate cuts can boost confidence in the markets. When the Fed lowers interest rates, it sends a signal to investors that it is committed to supporting the economy. This can lead to a rise in stock prices as investors become more optimistic about future economic prospects. They signal that the Fed is taking action to support the economy. This proactive stance can reassure both businesses and consumers, fostering a sense of stability and encouraging economic activities. In summary, rate cuts are a powerful tool used by the Fed to stimulate economic growth, boost market confidence, and mitigate the impacts of a recession. Section 6. The 1990s. Rate cuts and the dot-com boom. In the late 1990s, the Fed cut interest rates to support the economy during the Asian financial crisis. These rate cuts helped fuel the dot-com boom. The dot-com boom was a time of rapid growth in the technology sector. Many internet companies were founded. The stock market soared. However, the dot-com bubble eventually burst. This led to a market correction. Section 7, 2008. Rate cuts during the financial crisis. The financial crisis of 2008 was a major economic downturn. The Fed responded with aggressive rate cuts. These cuts were designed to prevent a complete financial meltdown. They helped to stabilize the banking system and prevent a deeper recession. The 2008 crisis highlights how rate cuts can be a powerful tool for policymakers during times of economic stress. Section 8. The impact of rate cuts. A mixed bag. Rate cuts can have a positive impact on the market. They can make borrowing cheaper. This can lead to economic growth. However, rate cuts can also have negative consequences. They can lead to inflation. Inflation is when prices go up. This can erode the value of your savings. It's important to remember that rate cuts are not a magic solution. Their effectiveness depends on a variety of factors. Section 9. Rate cuts and your investments. What to keep in mind. So, what do rate cuts mean for your investments? The impact can vary depending on your portfolio. If you own stocks, rate cuts can boost the market in the short term. However, it's important to remember that the market can be volatile. If you own bonds, rate cuts can decrease the value of your investments. This is because bond prices and interest rates move in opposite directions. Section 10. The bottom line. Navigating market corrections and rate cuts. Market corrections and rate cuts are part of the economic cycle. Understanding them can help you make better financial decisions. Don't panic during a market correction. Stay calm and focus on your long-term investment goals. Remember that rate cuts are a tool used by the Fed to influence the economy. Their impact can be complex and unpredictable. Section 11. Remember, knowledge is power. The more you know about market corrections and rate cuts, the better prepared you'll be to navigate them. Do your research, stay informed, and don't be afraid to seek advice from a financial advisor if needed. Remember, knowledge is power when it comes to your money. By understanding these economic forces, you can make smarter decisions and achieve your financial goals.